All right, now we are going to talk about IAS 19 employee benefits, and this is fairly an easy standard. All you need to understand in this standard is the major difference between the defined contribution and the defined benefit. This is the main thing you need to understand in the IAS 19, the difference between the defined contribution and the defined benefit. All right, employee benefit is all about the benefits given to the employees. So whenever the company is giving the benefit to the employee, it is actually the expense of the company. And the corresponding entry should be recorded in the liabilities. Like for example, if supposed to pay, you are supposed to pay the salaries to the employees. So what you do is debit wages and salaries expense and credit wages and salaries payable. Similarly, when you are supposed to pay the benefits to the employee in terms of bonus, so bonus is also the expense of the company and the bonus payable will be credit. Once it has been finalized that you are actually paying the bonuses to the employees. So the benefit may be of many types. IAS 19 defines 4 types of benefits. The short-term benefits, which belongs to the 12 months, for example, wages and salaries, and paid leaves, such as leave encashments, bonuses, commissions, and non-monetary benefits such as medical care, such as housing, cards, all those things. These are the employee benefits. Similarly, post-employment benefits, in which you have two things, the defined benefit and the defined contributions. And this is the major thing you need to know in IAS 19, the post-employment benefit, defined contribution and defined benefit. And then you have the other long-term benefits, such as long-term paid absences, long paid leaves, and long-term disability benefits, etc. And then you have the termination benefit, like for example, the golden handshakes. Like for example, if you are retiring uh, uh, in the earlier stage, then you will be getting the benefit on the termination. So these are known as the termination benefits. So such as you're getting retired before the normal retirement date, golden handshakes. That is known as the golden handshakes. That is known as the termination benefits. So the short-term benefits are related to the 12 months that should be expensed out within the current year. The post-employment benefit has two types of benefit, and this is the main thing in the IAS 19. Which there are two types: the defined benefit and the defined contribution. This is the main thing you need to understand. Now, defined contribution means that the contribution has been defined. And other than the contribution, the employer does not have any responsibility to pay a guaranteed amount. That is known as the defined contribution. And the defined benefit is in which the ultimate benefit has been defined. So defined contribution in which the contribution has been defined by the employer, and defined benefit is in which the ultimate benefit is defined. Let me give you a basic flavor, and then you will get all about the defined contribution. Let's say, for example, the salary of the employee is assumed currency unit 90,000, whatever the currency is. So dividing by 30 days, per day salary is, for example, 3,000. Now, it is the policy of the company that 3,000 will be contributed by the employee and 3,000 will be contributed. The similar contribution will be done by the employer. And that will be put in the plan, 3,000 plus 3,000. And whatever this plan makes within, for example, certain number of years, for example, 10 years, 20 years, whatever the figure is going to be, that belongs to the employee. And the employer does not have to guarantee any amount. All they will be doing is paying the regular contribution in the plan. This is known as the defined contribution. The defined benefit is that the ultimate benefit is defined. For example, they will be paying, say, for example, $1 million. Now, in order to make $1 million, they will be actually contacting the actuary that how much we pay now into the plan on a monthly basis or yearly basis, that after 20 years, it reach 1 million. So the only objective is that they will be paying 1 million out of the plan. So what they will be doing is employee will be making the contribution and the employer will be making the contribution. And this has been told by the actuary that how much you make a regular contribution for 20 years so that it makes $1 million, which is the guaranteed amount. So in the defined benefit, the employer will be having two responsibilities. The first one is the regular contribution, and the second one is if there is any shortfall in the plan. Like for example, the actuary is going to tell you based on the interest rates that how much you pay in the contribution as a contribution. But sometimes the interest rate may fall, then you have to pay an extra amount in order to facilitate your contribution. So that is known as the defined benefit. In the defined benefit, the employer will be guaranteeing an amount to be paid to the employee. So in order to meet that amount, they will be maintaining a plan asset to meet the plan obligations. So the present value of the present obligations, the present value of the obligations should be equal to the fair value of the plan asset. The entity does not have any objective to earn from it. All they need to do is to make sure that the plan asset is making all those amounts which is going to be paid as a plan liability. So IAS 19 is all about maintaining the plan asset in order to meet your plan obligations. That's it. There is no objective of earning something out of it. Although there may be a situation where your plan is going in the surplus. But the only thing you will be doing is to make sure that the fair value of the plan asset is equal to the present value of the plan obligation. In the defined contribution, you will not be actually guaranteeing any amount. You just know the regular contributions you will be making in the plan, and whatever the plan makes in those number of years belong to the employee. So no guarantees in the defined contribution and the guaranteed amount of the defined benefit. In the exam, the examiner may ask you to differentiate between the defined contribution and the defined benefit. So make sure you are able to differentiate between the defined contribution and defined benefits. So you have right in front of you the definitions of both. So according to accounting for the defined contribution, as I have already told you, the defined contribution is the expense of the company. So debit profit or loss, credit contribution payable. And when the contributions are paid, debit contribution payable and credit bank. So this is the double entry to record the defined contribution. That's it. An entity makes contributions to the pension fund of employees at the rate of 5% of the gross salaries. For convenience, the entity pays 10,000 per month into the pension scheme, with any balance being paid in the first month of the following accounting year. The wages and salaries are 2.7 million. So remember one thing, that if you are making any lump sum payment, still you have to compare it with your contributions. If you have paid more than what was required, that should be recorded as a prepayment. If you have paid less than what was required, that will be recorded as accrual. So once the entity is paying in a lump sum, they will be comparing it with their regular contributions. If they have paid more in the following year, that will be recorded as the prepayment. If they have paid less in the following year, in the current year, sorry, then that will be recorded as accrual. So you can see 22.7 million into 5% represents 1,35,000. So the statement of financial position will therefore show an accrual because they have made 10,000 per month multiplied by 12. They have paid 1,20,000, but the actual expense of the contribution is 1,35,000. So 15,000 is still unpaid. That will be recorded as the accrual. If they have paid extra, that will be recorded as the prepayment, prepaid expense that is recorded in the current asset. So again, you have a similar example. You can attempt it yourself. Now it comes to the defined benefit. in which the employer has two responsibilities. The first one is associated with the regular contribution into the plan, and second one is associated with if there is any shortfall in the plan. So in order to meet that shortfall, they have to inject an extra money into the plan. So there will be two responsibilities. So when it comes to the accounting for defined benefit, let me show you this diagram, and that will tell you what figures you are going to take within the financial statements. So there are three figures. If your plan is in the deficit, that will be recorded as the plan obligation. What you will be doing is you will be comparing the present value of plan obligations with the fair value of the plan asset. So if the plan obligations are more than the plan asset, the deficit will be recorded as obligation. If the plan asset is more than the obligation, the surplus will be recorded as asset. And then there is a concept of the asset ceiling, which we'll be discussing in a while. Now there will be the remeasurement component. I have told you that we are actually using the assumptions in calculating how much we should pay per month or per year in order to meet that amount which is guaranteed by the employer in the defined benefit. So sometimes the assumptions will vary during the year. Like at the start of the year, the assumptions were different. The actual results by the end of the year is different. So due to the difference in the assumption, due to the changes in those rates, there will be the changing in the liabilities that is known as the remeasurement component, and that will be recorded as in the other comprehensive income. Remeasurement gain or loss. Either it is going to be a gain in your estimation, or it is going to be a loss in your estimation. Whatever it is, either it is gain or loss, it will be recorded in the other comprehensive income. And then there is a service cost. In the service cost, we have two things. There's current service cost. Now the current service cost is when every year your employee is serving, your liability to pay them is getting increased. That is known as the current service cost. Every year your liability is increasing because the employee is providing you the services. And then there's a past service cost. Now past service cost is related to when there's a change in the remuneration plan, there will be an adjustment in the pension. That is known as the past service cost. There will be an incremental expense due to the change in the pension. So the current service cost is actually related to the current year. Every year the employee is providing the services, thereby they're entitled to one more year benefit, which is the expense of the company, that is known as the current service cost. And the past service cost is when there is a change in the remuneration plan. The change in the remuneration plan will lead to change in some benefits being paid to the employee. That will be again the expense for the company, and that is known as the past service cost. So both of these, the current service and the past service, are known as the service cost. Then there's a net interest component. Actually, there are two things. One is the plan asset. Another one is the plan obligations. Like you are maintaining a plan asset to meet the plan obligations. So the interest you are earning on the plan asset is your income. The interest on the plan obligation is the expense. So what you do is obligation minus asset multiply by the interest, that is known as the net interest component. So in the profit and loss, you will be recording the service cost, either current or past service, and the net interest component. In the other comprehensive income, there will be the remeasurement gain or loss, and the statement of financial position, either it is going to be a plan obligation when the plan is in deficit, plan asset when the plan is in surplus, and then there is a concept of asset ceiling. Let me describe over here as well. Asset ceiling means when your plan is in surplus, there are two possibilities. When the plan is in surplus, there are two possibilities. Either you can withdraw some money out of the plan, or you can stop some contributions for a while in order to balance the plan obligation, the plan asset, because there is no objective of earning something out of the plan. The only objective is to pay the obligations from the assets. So when the plan is in the surplus, the standard says that it should be recorded as a plan asset, but the amount should be limited to the extent what the entity is realizing. For example, if they are withdrawing something or they're stopping some contributions, uh, let's take an example. So the difference of the plan obligation and plan asset is, let's assume 100. But you are only going to withdraw $80 from the plan, or you are only going to stop the contribution of $70. So the standard says that you are going to record the plan asset on $70 rather than $100. And this concept is known as the asset ceiling. The next important thing in the IAS 19 is the working, which is right in front of you. So you can say that these are the free marks when IAS 19 is being tested in the paper. What you're going to see is opening balances of obligations minus assets, and then you apply the interest component on it. That will give you the net interest. Service component will increase the liability. That is why you see the positive figure. It includes both the current service cost and the past service cost. The contribution will be deducted. Now the benefits paid is the dash. There is no movement. Why is that? Because when you're paying the benefits out of the plan, it will increase the liability as well as the asset. So the net effect will be nil. That's why we are showing a dash right in front of this. So you will total these things, and this will be compared by the closing balances, and the balancing figure will be the remeasurement gain and loss that will be recorded in the other comprehensive income. So the most important thing is that you should memorize this format. So opening balance, obligations minus assets, net interest will be applied on that. Service component will increase the obligation, contribution will be deducted. Benefits, there will be no movements because it decreases both the assets and the liabilities, so the net movement is zero. And then the remeasurement component, which is the balancing figure. So you have example right in front of you. The following information is provided in relation to a defined benefit plan operated by Celine. At 1st January, the present value of the obligation was 140 and the fair value of the plan asset was 80. So the opening balances have been given. So 140 minus 80. So this is the start of the working. And then you see the closing balances as well. So you have the interest percentage for the net interest component. Current and past service cost is given for both years. Benefit paid will be ignored because it will not be shown on the format. Contributions will be deducted. And then you have the present value of the obligation, that means the closing balances. And then you have the fair value of the plan assets. So this is the obligation balance, and this is the asset balance. So you will be netting it off. So if you are thinking that the opening balance of 2005 is not given, the 2004 closing balances will be the opening balances of the 2005. It's the most easiest example and the most easiest standard that will be tested in the paper. So you just put the figures into the format. So you see the opening balance is 140 minus 80. The net thing is 60. You apply the interest component on it. Service cost will be added. Contributions will be deducted. And whatever the subtotal figure is, that will be compared with the closing balance. And there will be the remeasurement balancing figure. This closing balance will be the opening balance of the next year. And then again, the service component, net interest, contributions will be deducted. You see no movements in the benefits. And then you have the closing balances. Now you have the curtailment. Curtailment means when you are reducing the plan due to the redundancies. So when there are redundancies, the plan will be reduced. Any payment out of the plan should be compared with the carrying values. That will result in the gain or loss on the curtailment, which will be recorded as the component of the service cost. That means now the service cost will have three components: current service cost, past service cost, and the curtailment gain or loss. So you can see that the curtailment gain or loss is right over here just like the service component. And rest are the same. Liability, net interest, current service cost, the rest of the format is the same. Then you have the settlements. For example, if there are any employees, they're moving to another employer, and they say you that you can shift their uh, pension plan to the next employer. So if you are settling their pension plan, this will result in the gain or loss that will be recorded in the financial statements as well. So the gain or loss settlement comprises the difference between the fair value of the plan asset paid out and the reduction in the present value. So the carrying value versus the payment you are making, and is included as part of the service cost. So any gain or loss will be recorded again as the service cost component. The asset ceiling thing, I have already explained it to you, that when your plan is in surplus, you have two options. Either you can withdraw some money out of it, or you can stop the contribution for some time. Whatever you are doing, so your plan asset should not exceed the amount that is recoverable from the plan. That concept is known as the asset ceiling. And in the last, we have the termination benefits, just like I've discussed the golden handshakes and things like that. And then other long-term benefits such as long paid leaves, etc. And the last thing in your standard is the disclosure requirement. So this is fairly an easier standard. You only need to remember the difference between the defined benefit and the defined contribution, which is again important for the exam from the theoretical perspective. The second thing is that you should know the double entries for the defined contributions. The third important thing is that you should know what figures you will be recording as part of the defined benefit plan and what is the format. Another important thing is to know about the asset ceiling concept, because it may be asked in the exam in the theoretical portion. And the last thing to know is all the disclosures.